got a phone call today from a friend, and he asked me, he goes, okay, is the Fed going to pivot? And I'm like, okay, what are you reading? That's the first thing I think when someone calls me. And he said, well, I hear the Fed's going to pivot just like the UK pivoted. So I want to talk about what's going on with that today, if that's true. If it is true, what would it look like and how would we know? And my opinion on whatever this Fed pivot thing is. And whether you're 50 or 80 or 35, what the Fed does matters. Stick around. Hey everybody, this is RC Peck, and this is my weekly video update with Fearless Wealth. Good to have you here. I'm going to talk about the Fed today. I'm going to talk about what they are doing and are not doing. I think a lot of people misunderstand what the Fed actually does. We're not actually going to get into that part today. We're going to get into what the market is doing, how it's acting and reacting, the stock market, the bond market, the housing market, because it matters. So if you own a house or if you have money in the stock market or the bond market, this week's video is really going to speak with you. Now, I know that's just about everyone, so it should be a good video. Okay, so let me do this. I'm going to jump over to the price charts. I'm going to look at a couple tweets today of other people, and really let's look at how the Fed is affecting all the markets today. Okay, so let me move over to the price chart. Okay, let me get this. Put me up here, get me out of the way here a little bit. Okay, so this is corporate bonds. Now, specifically, it's an ETF called LQD. The iShares iBox $ investment grade corporate bond ETF. Whew, that's a mouthful. Did not have a good marketing team on that one. Basically, it's US corporate bonds, and this is a price chart of it. The big, huge, scary dip was the COVID crash. Now, here's what's interesting. At the bottom of this, the Fed came out, Jerome Powell came out and said, hey, we'll buy corporate bonds if we need to. I thought they were buying corporate bonds, and that's why the price of corporate bonds stopped falling. They never bought. All they said is, we're willing to buy corporate bonds. Fast forward to 2022, look at the price chart. They're not buying corporate bonds. They're allowing the natural price to happen, right? They're allowing natural price discovery. Allowing natural, ANPD, allowing natural price discovery. So they are allowing people to discover on their own collectively what's the proper price for corporate bonds. So the Fed is not going to be buying corporate bonds. They did back in 2020. Actually, they said they were going to, which is as good as them saying they did. But that's not the case now. The Fed is not stepping in to help bondholders. And we could look at corporate bonds or any type of bond. They're all, I could actually say crashing. Bonds are having their worst year ever. So the Fed is not going to step in and buy bonds. The other thing we know they're not going to do, and let me zoom out a little bit here. They're not going to step in. Let me bring up just SPY. At the end of 2018, the stock market almost fell 20%. Maybe intraday it did fall 20%. Now, the reason it stopped falling is because Jerome Powell came out and said, okay, I'll stop raising rates. Now, rates were already increased from 0% to 2.5%. The federal funds rate was already increased. And just always looking to move that out of the way. Okay, so the market stopped falling. The market stopped falling because the Fed, or Jerome Powell, came out and said, I'll stop messing with rates. And then the market went back up until the COVID crash. So this is another situation where the Fed coming and saying, I got it. I hear you, market. You're falling. I'm listening to you. The Fed does not care if the stock market is falling or the real estate market is falling or the bond market is falling. We know that because all three of them are falling and the Fed hasn't changed its direction. Now, some people believe there's going to be like a Fed pivot or something like that. It is not going to happen. Let's get some information out of the screen here so we can see more of it. The reason why the Fed's not going to pivot is Jerome Powell came out and said, look, I want to raise rates until they're above that black line. So if you look at the screen, there's a black line. called the core PCE inflation line. Okay. Core PCE is still way above all the yields for the US Treasury, from the 30-year yield all the way down to the 3-month yield. Jerome Powell said, I want all those yields to get above the core PCE rate. That means all these yields need to go much higher, and or the PCE core rate has to come down, or both, right? But the idea that he is going to pivot right now, I think, is a very, very, very low probability. Okay. The other reason why I don't believe the Fed's going to pivot is, and I know I don't want to give too much information to overwhelm people, but what I want to show you here is this price chart right here. Now, this is a yield spread, relative yield spread between basically corporate bonds and the US Treasury. What I want you to take away from this price chart is it's not spiking, right? There's not a huge spread right now between the 10-year US Treasury and corporate bonds. Until there is a huge spread, there's probably no thinking that the Fed is going to change their direction. You can see on this chart back in 2008, the spread between corporate and 10-year Treasury yields. It peaked at 6%. Right now, we're at about 2.25% difference between the two. Back in 2000, the 2000 crash, the difference between those two yields, we can still say peaked. It spiked almost to 4%. We are nowhere near spiking right now. The Fed's not going to pivot. Look, the stock market probably needs to fall. It's been jacked up with money printing and zero interest rates for a long time. So it is looking for its natural price right now. It doesn't know its natural price because it had only zero interest rates and trillions of dollars of printing behind it. So it is looking for its natural price level right now. Okay, then the question is, are they going to help housing? Is there going to be housing? Now, here's a great chart that I've seen on Twitter that talks about housing here. And let me just read you this. How much can you buy with a $2,500 monthly mortgage payment, assuming a 20% down payment and an average 30-year mortgage rate? So you've got 20% down and you're able to pay $2,500 a month. How much of a house can you afford? It has dropped a lot. The peak was $758,000. You could have bought a house for $758,000 when the 30-year mortgage rate was at 2.625. Today, the 30-year is at 7%. 30-year fully amortized mortgage rate is at 7%. That same house, or your same $2,500, can now only get you a house that costs $476,000. Now, it's not quite, it's about $280,000 less of a house you can buy because mortgage rates went from basically a historic low of about 2.625 up to 7% right now. Housing prices have to adjust. People don't buy a housing price, they buy a monthly mortgage payment. So there's going to be more pain in the real estate market. Now, why did rates go so low? Because the Fed, they bought $1.37 trillion in something called mortgage-backed securities. Securities that help mortgage rates go lower. I had to write this down, 1.37 trillion. Now, they didn't buy it over a decade or 2 decades. They bought it between March of 2020 and April of 2021. That's also known as 13 months. Let's just call it $100 billion a month of mortgage-backed securities the Fed was buying. That is not happening anymore. So the mortgage market is also having to find their natural price level, just like the stock market is, just like the bond market is. That's why we are in what we are in right now. The Fed is not falsely, inappropriately, manipulatingly, you use the word you want. They've stopped doing that. And so the market now has to figure out, it's called price discovery, what the fair price is for housing, for bonds, and for stocks. Okay, so let's wrap this all together with what is going on. In other recessionary falls, I don't know if we should use stock, maybe not stock market crash, there's definitely a bond market crash going on. Back in 2008, bonds were going up and the US dollar was going up. Back in 2000, bonds were going up, the US dollar was going up, the Japanese yen was going up, and gold was going up. None of that is happening today. The only asset that is going up is a currency, and it's a very specific currency called the US dollar. There's nothing else going up today. The reason why bonds aren't going up is because the Fed has stopped buying, Japan has stopped buying, China has stopped buying. Those are the three biggest buyers of US treasuries. Now, Japan and China, they not only stopped buying, they're starting to sell some of the bonds they own. So the three biggest bond buyers have stopped, and two have started to slowly sell. We have more weakness in front of us. The stock market, depending on which stock market you're looking at or how you're looking at, is down somewhere between 25 to 33%. The S&P is down about 24 or 5%. I think at a minimum, the S&P is going to fall 33%, and the NASDAQ 100, or QQQ as most people know it, is probably at a minimum going to fall 43%. Now, the good news is we're almost there on the S&P for my short or my near term or best case scenario fall, right? We're down about 23, 24, 25%. And best case scenario is we only lose 33%. So we're only about 10% away from that. But we definitely have more pain in the market. Things are starting to break and bend, but nothing's really broken yet. I see what's going on in the UK, but the pound doesn't really matter that much anymore like it did 100 years ago, right? Great Britain is breaking up. It's not going to be Great Britain in 10 years. It's Northern Ireland, called Ulster, is going to go back to the Republic of Ireland. Many people didn't know that's what Ireland was called. So England's going to lose Northern Ireland. No one really cares what happens to Wales. People can't even find it on a map. So whether they stay with England or not, it actually doesn't matter economically. And I believe Scotland really wants to be part of the EU again. So they're going to leave England's little consortium. And what's going to be left with Great Britain is England and this little country over to the left of it called Wales. The point is the pound doesn't matter as much today as it did maybe 50 or 100 years ago. So a lot can go wrong with the UK and not affect other parts of the world. Same thing with Sri Lanka and Ghana. Now, of course, the Great Britain is way, way bigger than Sri Lanka and Ghana and other smaller countries that are defaulting. But the small countries, ultimately, it doesn't matter that much, right? It matters more who lent them and how levered that entity is who lent them money. So tying this up, I said I would do it. Let's land this plane. More weakness ahead. The Fed has stepped out of the way of helping tens of millions or hundreds of millions of people. They are going to continue to raise rates. They are not backstopping the bond market, the stock market, or the real estate market during this recessionary fall. Thanks everyone for being in my world. I appreciate you watching these videos, leaving the comments. I respond to all of them. And let me know where you think I got it right, where you think I got it wrong, and maybe what I missed. Okay, until next time, this is RC Peck with Fearless Wealth. Thanks.